Well, good afternoon, good evening, good morning, everyone. I hope you're doing well today. A little bit of a sound check here for a moment. All right. So I hope you're having a good day today. We have a lot of movement in the markets. We won't be talking about that. We're going to talk about the subject at hand. And that subject is letting go of what you know. For those that are new to trading or have been trading around a while, this is one of the subjects that's kind of near and dear to my heart because of the impact that can have when you stop looking at things the way you've always looked at things and you look at them in a way that kind of enlightens and empowers you in your trading and financial world. We're going to talk not only about trading today, but we're going to talk about investing, swing trading, and all the aspects of motivation for getting into the market, and what those different motivations might be for different folks, and how they might want to adjust what they're doing or give an opportunity to adjust what they're doing to improve their condition. So letting go of what you know. Before we get started, of course, we have to be very conscious of the Federal Trade Commission guidelines. And available research says that most day traders are not profitable. And of course, any analysis given here is no guarantee in the stock market. Also, all trading comes at risk. We all acknowledge that there's no guarantee of success in the stock market or any securities market. And the copyright information is very clear that nothing that I say or nothing that I show should be showed on any other social media or used in any way besides the viewer. Okay, let's get into it. We all have very different backgrounds, and there's a myriad of differences that we have growing up. We're different ages. We've had different financial history. Um, Many of us have worked a long time in the work environment. All of those kinds of things we're going to talk about briefly here, so we can kind of get a context for why that's important and why that comes into play. We also have very different influencers. Some of us might be financially trained. Okay, not that that's necessarily a positive thing, but we could be financially trained. We could be lawyers. We could be doctors. We could have different people that we look to for advice or consideration or provide us opinions, or we provide opinions too. There's also the different media sources, the different textbooks, the different uh, maybe social media sources that we have that influence how we feel about things, how we act on things, and not only in a positive manner but in a negative manner. Things that influence us to kind of hold back and not do things. We all have very different experiences as well. Like I was saying, we may be really new to thinking about taking control of our financial world. Also, some of us may be looking to get into to day trading or something like that, and never having experience before. Other people may have a lot of experience, um, and some very success with those experiences of investing and trading in the markets. Oftentimes, people do that without any guidance or training of any sort to kind of align themselves with what they wanted to do, and they just kind of dive right in. So a lot of those experiences are very negative. There is documentation that I think it's by the FTC actually, that around 95% of day traders are not successful and walk away. Now we know what that means. That means they threw money at the problem and they lost it. Okay, so our intention at the Pinnacle Institute, using Pinnacle methods, is to avoid that at all costs. No pun intended. If we can help that for our members. We all have different financial situations as well. There's people that come in have very limited financial resources and are looking to improve their condition. There's others that have very substantial financial um, wealth, if you will, and then there's all the people that might be reaching a point in their life where their their needs have changed. Okay, so everybody's a little different in that way. So all in all, that's really important to reflect on that, to understand when you have these influencers coming at you or people giving you recommendations or stuff, they don't have that context for what you're about and what you want to accomplish near term and long term. We all have very different financial prejudices as well. There are people that really don't want to do a certain thing in the financial world because of what they've heard or what they've experienced. So those prejudices make each of us different, again, making it very difficult for others to appropriately influence us or us to allow or bring in the correct others to help us deal with things. Many of our prejudices may be absolutely incorrect, as most prejudices are. The context is always missed when someone has a prejudice about something, and it just could have been that experience um, or something, a tape that's been driven into their brain to think that way. Of course, we all have different abilities, whether it be technology, reading, understanding concepts, uh, thinking broadly or thinking narrowly enough to be successful. So we all have different abilities, and there's always an opportunity in the financial world to leverage the unique, specific traits of a person along with what they want to do in the financial securities world. We also have very different technical skills. Many of the people that come into trading are very adept at surfing the internet, working spreadsheets, working, learning the tools of trading, etc. And others are kind of new to it, kind of timid, a little bit scared, don't have a lot of experience and trust in technology, and so that has to be understood when you're talking to people about different strategies and things like that. Because just an example, some of the option strategies and the options tools can be very technical and very ornate, because they have the ability to keep creating widgets for those things. And to a new person that isn't really hasn't grown up with technology, it can be very intimidating, even though it needn't be. The fact is that it could be, and that's an important aspect of many people when they step into trading, is just those technical skills to do the basic activities they need to do. A big one with me, especially, is we all have different willingnesses to change. As people, the subject of this being letting go of what you know, um, people are very uh, s- exposed in the financial world, and therefore they aren't going to change unless they're really, for some way, forced into it, if you will, or they've really reached a point where a precipice where they must change, or things are going to go very badly for them. And in the financial world, a lot of people that um, unwillingness to change makes them walk away from the game. Okay, they just walk away because there's too many aspects that challenge their resistance to change. Okay, so but for those people that are very willing to change, um, they have issues as well, as they don't do the diligence to make sure the direction they're changing is the correct direction, right? Very um, quickly move from spot to spot. So both have goods and bads. However, that is something that needs to be taken into account when a person comes into the financial world. Very important aspect. We all have different abilities to manage our emotions. Very gambling type personalities come into the financial world, and on the other side, very timid, very cautious, very stoic, and wanting a lot of proof before they do anything. So there's different ends of the spectrum, and many people, when they're doing different things, kind of go between um, both ends of that spectrum. They can get very emotional when things don't go bad, or they can get very emotional when things go really good, and the reverse of that, of course. We all have very different levels of independent tendencies. There's a lot of followers, and that's just the way it is. The culture makes that happen in many parts of the world. Um, so they're very willing to accept what is told of them or told to them, or uh, that if they get into a group of people that are talking, they'll kind of go for the consensus of what everybody's thinking. So there's that, and then there's other people that are really trying to break out and make their own path and things like that. You'll find that those are the people that are more willing to change as well. Both aspects can be successful, but to acknowledge what that is within yourself is very important. I don't know what you guys had for breakfast, right? I say that as a kind of a wrapping it all up. So when you are talking with someone, or when someone's talking with you, or you're thinking about doing something and you're engaging others to decide on what that is, or you're reading up on an internet strategy for trading, or whatever you do in the financial world, all of those things are crafted for a certain, call it an avatar of an individual. They don't know anything about you. And what you had for breakfast is just an example of that, so you can remember it in your head. When someone's giving you advice, they don't know all the pieces of you that are reacting to that and how they're reacting to that. Because you could put on a really good facade for your willingness to change, for example, but you're truly not inside, right? You know that. They don't know that. You know that. So when you go into this stuff, you have to be very honest with yourself, where your limitations are and where your positives are. What are you good at? What are you not good at? What do you need to get better at? What technical skills are you missing? All that kind of stuff. It's all within you. It's not anyone else's responsibility, and no one's going to hand it to you. So um, keep that in mind as we go through here. That just because you have a certain feeling in a certain way doesn't mean it's wrong. It's just the way you are, and that's okay. And that can be dealt with and leveraged in many cases to the positive for you. We all have different reasons for what we think we know, right? All of our influences have been different and all that, and the way we are, what we've listened to, what we've ignored, etc. Um, but what if we know? What if those assumptions we know, or those mores we know, or those things that are just fact to us? What if it's not right? What if it's not right? What if the things that we know just aren't right? What does that do for you? All of this picture here is just showing a guy that's he's a book learner. He's the way he's been his whole life, and that is it. That is his world. And what if that world um, turns upside down? What if it does need a change? And what does it take for you specifically, with everything that you currently are and you know and your experience and all that, to change what you feel or believe? What does it take for you to change what you feel or believe? Now, in the financial world especially, that's a very tough question, because many people are really hesitant to adjust what they think and what they believe in the financial world, because it just is, for whatever reason, all those things that we talked about before, it came down to, that's my opinion now, that's what it is. So what I'm going to start talking about in the next part of the section is I'm going to keep alluding to other ideas, um, to generate the possibility of a paradigm shift of what is in the financial world and what is in the world of many, many people. You know, no one's completely unique here, that have similar feelings or actions or behaviors based on what they see and acting from what they believe they know. All right, a paradigm shift basically is when you can get some influences that kind of change your view of your world. All right, I have a very long presentation, um, in the Pinnacle Institute, that talks specifically about the paradigm shift, um, because I feel it's a very important aspect of going from where you are to going to the next thing. You have to break down some walls. You have to change things in the way you're thinking about things in order to go and experience something very different. Okay, and you will find that the Pinnacle methods and supply and demand trading are very different than what is generally out there. Okay. And speaking of what's generally out there, is there real news? Is there news that is absolutely correct, 100% correct? Well, sure there is. Um, for the most part, financial statements of companies, that's real. Interest rate reports, those are real. Um, the actual facts that they put out there can be real. How they spin them, however, and what they say that it means to anything, that can be very different, right? But there are true facts out there that can be taken as facts. But is there fake stuff? Is there fake news when it comes to the financial world? Well, it's all around us. All right, and bear with me. I'm not here to beat these people up, um, but you'll hear of people out on the internet that are making tons of money with this strategy and all that. Okay, that could be fake news. That has to be concerned that they could be selling a strategy or just trying to get advertisers to wherever they are, and that's truly fake news because it's not really providing any value to you, and it's sensationalized, right? There's also, and this is Michael Bloomberg here. You know, Bloomberg.com is basically what that's showing, and uh, Kramer here at CNBC, and you got, yeah, CNBC. So there's financial news networks that put stuff out, and oftentimes what they put out is true but deceptive, right? It's put out there, but it has an agenda behind it. They're trying to push this product or this behavior or whatever, or maybe just they're selling advertising too, so they have sensationalized whatever they're talking about. But generally, they try to stay even keeled and all that, but they're always influenced by advertisers and by other things, politics and stuff that makes it so it's not necessarily put out there as against you, but it can be kind of imagined different than is reality. And down on the bottom, I have a couple of neighbors talking across the fence here. Um, when it comes to taking advice from someone else, just a simple act of that can be fake as well because they could be passing on rumor or or things that aren't really based in anything, but potentially trying to influence your behavior or your acceptance of the piece of news from them. And that is also something to be cautious of because even though your neighbor's wonderful, has a good heart, and all that, it's possible that those conversations influence you of what you know um, in a poor way or a less optimal way. And of course, is there really fake news? Well, yeah, there's one of the sources of that, and they will spin it and all that. And still, in today's environment, and the way that politics and all that are held today, you'll get certain people that will accept it as fact and act on it, and other people that will reject it immediately and act on it. So there's really no good strong answer for any of the information that comes, especially from that neighborhood. Um, but just be aware, all of this stuff is influencing your perceptions, what you believe you know to be fact, and uh, potentially how you'll act or how you will be timid about acting. Right? So, does it make sense to be fearful with all these news sources and I'm telling you not to trust them and all that kind of stuff? Well, yes. Anyone without a plan should be very fearful of this environment, or especially in the high volatility. And think of all the possibilities in the financial world where someone who could have enough money to push an agenda, and to trust that kind of thing has to be taken with a grain of salt, if you will. So again, many people believe that they know stuff because it's been told to them because they can't know every source. They only get what they're told, um, or hear, if you will. And in the financial world, especially because there's so much money, quote unquote, ironically involved with that, it's very prevalent out there. And an important aspect of that, whether it be your neighbor, whether it be someone on the internet, advertising something or trying to get your attention, whether it be any of the financial news networks or websites, whether it be a politician or whatever, they're trying to get you to play their game. And at the Pinnacle Methods, we try to play your game. Remember all those aspects I acknowledged of how we're all different at the beginning there. That's what's key to being successful is you need to manage all what's coming in at you, um, but understand that they're trying to get you to play their game, and we all need you to turn to play your game. And what that game is we'll talk about briefly here near the end. But it's truly not taking all of that stuff and being so stuck in what you know because what you know could be wrong. And the key thing about their game is it's designed to benefit them in some way. I don't care if your financial advisor is wonderful, or your neighbor's wonderful. Your neighbor could be looking for just the acknowledgement that you think they're smart, or thank you for the piece of information, whatever. But it's still playing their game. It's not really looking at the market in a way that's objective, if you will, right? And when it comes to all those other things, it's very obvious that they benefit in some way if you play their game. They're trying to push you to do a certain thing. We're going to talk about a few examples of those right now, in order to kind of drive this home. But this is for me, when it comes to the Pinnacle methods. This is very key in that you have what you're trying to accomplish, and all these other people have what they want to accomplish for their own benefits. But there's very few times when the two align, right? You need to stay within your box, and you need to play in their big box, but you can reduce it down to where you're doing your thing, and what they say becomes less important, and therefore what you need to know becomes less important. With most people, in order to change, they need to be challenged in a way that's pretty basically simple to see. If we put too much complexity trying to convince anybody of anything, it falls flat. You may lose their attention, etc. But there's some things you need to keep in mind with everything that comes in front of you, and how the influences are balanced. Is everyone has an agenda, and they're doing what they need to do or feel they need to do to increase their wealth. I should repeat that. Everyone has an agenda. You don't need to be paranoid about that. You just need to acknowledge it. When you see news, there's an agenda. It may not be obvious, and sometimes it may be obvious. When you when you deal with anybody in the financial, they have an agenda. When you talk to a financial advisor, they're very wonderful people. They have wonderful oak and mahogany desks and wonderful offices, and they take you to lunch, and it's all really nice. But they're not doing it because they're your best friend, and they're your guardian angel for your financial situation. They're making money when they do that. So therefore, what they do also has to be taken with that grain of salt, understanding that they're doing things to help them, and not exclusively you. No matter what they say about what's the word, fiduciaries, it's really not true, because if they take a dollar from you, they aren't completely on your side. You always have to protect yourself. And a huge one in the financial world is arrogance is everywhere. I've let a few people off the hook here on the previous things when I was talking about the news, but there are many people out there that all the financial world goes to talk to, and they keep going to them because it's easy for them to do so, right? Um, but the arrogance of some of the hedge fund managers, and the people, the bond managers and all that stuff, they're extremely arrogant. So challenging them is almost looked down upon, because who are you to challenge them, etc. Right? Well, we've had a lot of information. We've had a lot of examples in the last 6 or 7 years of people that challenge and should have been challenged. Right? We won't get into that, but um, no one's perfect, and no one has all the answers. Is the key there. Opinions also can be very cheap. If someone's giving you an opinion on a financial decision, and they don't know all those things about you that we talked about earlier, it's actually dangerous, because they're recommending something to somebody that may be not ready to accept it in the in the way that it's been given. Okay, they may have a wonderful heart and are doing it because they want to help and all that, but that doesn't mean that you're able to accept that and act on it correctly, and not just you, but anyone. So it's very dangerous to give advice, and it's very dangerous to accept advice, because the consequences aren't on the person giving the advice, they're on the person taking the advice, right? And also, if it doesn't work out, now you might have lost a friend, you've lost a source that might actually be a long-term good source. So all of that is needs to be validated, and again, at the Pinnacle Methods, we have ways of validating all of that kind of thing. All right, so I want to go through this example of what we know, and I'm sorry, I forgot to look to the chat. I will do so more often here. What do we know about gold? Well, gold hedges portfolio risk or inflation. Gold is a valuable investment tool. Gold never loses value. Smart people have their money or some of their money in gold. Rich people have money in gold. Every smart portfolio, you see commercials where the wealthy celebrities and all that say, we put our money in gold. They do that all the time. Every smart portfolio holds gold. Well, what we do at the Pinnacle Methods is this is a great statement that is spouted by one of the founders. Um, Trade what is real, not what you feel. Oftentimes, all those things about what we know becomes a feeling, becomes in something that puts us in or out of something because of the way it's feel, the way we're prejudiced against it in a way. But trade what you will, you is real and not what you feel means look at this chart right here. Now, this is two different sources of these charts, but this is it's in it looks different, but it's the same. So the purple shaded area is the interest rate up through I think it was 2 weeks ago, maybe 3 weeks ago. This is the interest rate this year. You can see September 21 to current day, all right, 9.06. I'm sorry, I said interest rate. I meant inflation. This is the inflation rate. Gold basically went reached a peak right about here and then has come down ever since when the inflation rate continued to go up. So when they tell you that there's a relationship where gold protects you against the interest against inflation, notice here. See about where gold was about 165 to 170. Notice in July it actually got below that. Now, is the sorry, I keep saying interest rate. Is the inflation rate gone? No. So this is proof that that's a misnomer, that it is a hedge against inflation, is it not? It's in the chart. It's right there. Now, there was a period of time when inflation was increasing, that gold was going up very dramatically, but there was no call looking at the interest rates to get out of this, was there? And that would have been the play, of course, to get out and then maybe even short it on the way down. However, the key thing here is people know, or they will reflect that they know that that's true, and this chart shows it very clearly that it's just not true, right? There's many aspects of this where you can look at what is real and dispel all those things that people feel. And when I say feel, I'm talking about the influencers of what people know, and become conventional wisdom and just accepted fact and lore within the financial world. All right. So this is the investment decision process. We'll determine the required rate of return. We'll look at our portfolio, look at what kind of return we want. We'll evaluate our investment to determine if its market price is consistent with the required rate of return. We'll estimate the value of the security based on its expected cash flows and your required rate of return. And we'll compare this intrinsic value to the market price to decide if you want to buy it. Okay, this is an investing strategy, if you will. No, it's not. This is something that can put you down a rabbit hole of never knowing enough to make a decision, and we don't want to be in that process. And I would never, I would never wish this upon anyone to invest things in that way, because when it comes to anything like that, most people have limited time, and the the time spent on that and the value that they would get out of it, at all, is very suspect. So you want to make sure that you do things that make sense for you and don't put you in a position where you're competing against someone that's been in the business 40 years doing that. You want to be in a position where you're doing something that you can do. Another example here is the risk and aggressiveness are key to profits. Notice this curve here. This is the return, expected return, low to high. This, and it's all relative. And this is the expected the risk. So low to high, and high is over here on his cuff here. Um, and the industry says they'll give you portfolios, et cetera, for moderate growth, aggressive growth, all that, and your risk will increase your returns. So if you want to make more money, you have to take more risk. Okay. This is again one of those things that's become just pervasive in the financial world, that they are they are aligned. Okay. Now how they define moderate growth and aggressive and assertive and cautious and secure and all that, that's a thing in itself. There's a lot of aspects into picking those securities, if you will, or the stocks. And but this particular um, model can be thrown out the window when you use the Pinnacle methods. There is no necessarily an approach to take a higher risk when you're looking for higher profits. It's actually a trade plan thing. Okay, so real quickly, I've mentioned conventional wisdoms a couple of times. It's very important to understand conventional wisdom because it is what has built the financial markets. Um, because of the complexity, because of the clubbiness of the financial worlds, there's a lot of conventional wisdom out there that can be dispelled. But it actually becomes a very lazy way of making any financial decision, potentially in the wrong direction or under unknown rationale. You, in most cases, even the people that are spouting it don't know the reason and the underlying basis for what they're saying. And it's very, very probable that the guidelines or the goals that came up with that little nugget of conventional wisdom don't necessarily align to your goals or aren't important for what you're trying to do. But it is a nugget of information out there that people will hesitate to deviate from, and it becomes groupthink. For those that don't know what groupthink is when you get a bunch of people together and a portion of the people start saying things that are common and they agree violently. And then because they agree violently, they come up with things that everyone continues to agree violently with and never get challenged. And that's very expensive because, oh, mistake. Sorry, I didn't mean to do that. Because what happens is those particular items that might add value to the team get knocked off because they can't get through the filter of the group think. So oftentimes these conventional wisdom things or the things that you see out on the internet or in the markets or the financial world become unfiltered things or filtered things that just don't add value to the overall goals that most people are looking for, and it hinders creativity. And creativity, when you're individually responsible for your financial world, is extremely important. You have to stay more nimble. All right, so now we're going to continue to go through some conventional wisdom with the aspect of how you can change what you know, or letting go of what you know. What goes up must come down, and the reverse of that, what comes down must go up. Well, that's not true. It shows all the time in the charts. You can see it, um, but oftentimes the what goes up must come down makes people get out of very successful positions. Okay, and that needs to be tempered. You need to watch for that because that will be something that paralyzes people in the markets where they will not accept success. They won't let success do its work, and they'll kind of hinder their returns because of that behavior. The market is too high. Well, it's good to understand what a market is. A market is the buying and selling, that would be demand and supply of securities, whatever it is, commodities, whatever it is. And just the daily buying and selling is why the market is what it is. So there was just as many, there was more people willing to buy it up to that price than are willing to sell it. So as long as those people exist, or those institutions or whatever exist buying, it's not too high. It's exactly where it should be. There is no market in the world that isn't exactly where it should be, based on the people that want to buy and the people want to sell. When we start making it a human being out there, or personifying, getting some personification of a market and thinking it's um, anything other than what it is, we get into trouble and start making decisions or not making decisions based on that information. One of the buzzwords that I've heard in the last several years, inverse yield curve predicts a recession. Well, now we don't even know what a recession is anymore, but they will say it's within 14 months. Now, the last one they had was, in the last 2 years, and they'll probably try, or 3 years, and they'll probably try to say, 20 years from now, they'll say, well, yeah, it proved it once again. Even though COVID caused the recession, they'll still take that as credit. But within 14 months, how is that valuable to anybody to know that? If that's the truth, if a inverse yield curve predicts a recession within 14 months, is anybody going to do anything on that today? No, probably not. But it is one of those things that the Wizards of Smart over in the bond world um, kind of tout all the time. Money taken out of the market should go to bonds. A diversified portfolio. One of the things that is always assumed is that if you take market money out of the market, it goes to bonds. Well, you might have seen in the last couple of years that is shifting. They are finally realizing that bonds aren't the hottest investment during certain times, and I would say for a very long time. Um, and at the Pinnacle Institute, we talk about that a lot. What is the value of bonds? Diversification is the right investment strategy. I can go the rest of the session talking about diversification. I'll just say that when you know if things are more likely to go up, and when you know when things are more likely to go down, it makes more sense to get into things that are more likely to go up and get out of the things that are more likely to go down. I'll just leave it at that. I don't believe in diversification as a rule, and I I think there's pretty good proof of that in the supply and demand strategy of the Pinnacle Institute. Money is in safer hands when you have a financial advisor. Okay. Like I said earlier, they're there for their reasons. Okay. If there was an advantage of them to have your money, they wouldn't have your money. Also, looking back at number 5, because of the diversification strategy that all financial advisors seem to do, they keep you in something by putting you in bonds when you get out of stocks because that's the right thing to do because they're following that conventional wisdom in the industry. But what that might do to you is put you into something else that's going down as well, because that's what's been happening with bonds and stocks. But if you look at what's real and not what you feel or what they feel, you'll find that there's lots of opportunities to not do things that a financial advisor normally does. Taxes are the most important thing to focus on. There's a lot of people selling taxes and tax strategies and all that kind of stuff. All good stuff, but when you come to the Pinnacle method, you'll see what's most important is buying things on sale and selling them at retail. That's the most important thing when it comes to making money. And the taxes are just kind of an, an afterthought. The idea is to make as much money as you can. Then the taxes are something else. There are strategies that people can use to minimize their taxes for certain situations, like 401k conversions and all that kind of stuff, of course. But those are truly financial things. Those aren't really trading and investing things. A few more of these. Um, People think that very experienced financial people are great investors. Would you be surprised to know that the greatest hedge fund in the world made like 9% in 2020? 9%. Okay. So they're not necessarily the great investors that they spout to be. They manage risk, and I would say they overly manage risk, and they miss out on all the moves that could make them money because they have to protect their money every night and all that. They have a different situation. An individual has much more power than any of those billion-dollar funds do. Um, if people are seen on TV or write things in newspapers, they know more than you. And I found that is not the case. Women are different from men. Of course, we know that. So there's one that's true. Diversification has less risk. But for who? Diversification itself, what that will do is get you out of the things that have over accumulated, if you will, in your account and get you into things that haven't yet. Um, it also keeps you 100% invested at all times. And again, not to beat up too much on the financial advisors, but something that they don't say is they get paid to keep your money invested. So if they are moving you from stocks to bonds or stocks to other stocks, the key thing is they get their percentage that month for for the amount of money you have invested. If you sit in cash, they don't get they don't get that rate. Um, Wall Street is smarter than the average investor. I'll just leave that there. I'm not going to comment on that. I beat up people enough today. Options are too hard and too risky for most investors. When you look at options as a whole, yes, they're very complex. Okay. But options are defined to mostly manage risk for commodity purchases. That's what they originally were, for commodity purchases and managing. So a corn farmer didn't go out of business. Basically, what they came in for. Um, but they're a very mathematical solution to price movement in all markets, with the intent of, based on the current prices, certain odds of the price going up and down a certain percentage for everything. And when you can change options to not be just that risk approach, but also as a profit or an insurance company type approach, um, the risk actually comes down, and the simplicity shows itself. You don't need to use everything about options in order to make money on options. You can just pick a nuance or a certain aspect of options and just apply that one again and again and again and never change and be successful. So they're only hard because they're complex. I mean, brain surgery is complex, but you can teach someone to clean the skin before the surgeon starts. And if you're focused on the whole operation, you're not going to clean the skin very well. But there are things within options that are really simple to understand, and many people are very successful at just starting on aspects of options that work for them. Value of the dollar goes down during inflation. Well, we know that's not true, don't we? Um, it's kind of a rare event, but in the last year, we have seen the dollar going up during inflation, and that is a that could be a challenge if the dollar decides to go down. If we have inflation, then it could be trouble. But right now, that is not conventional wisdom anymore, because we have broken that model this year. A few more if you buy company stock, it supports the company. How many people out there know that when you buy a company stock, you're not buying it from the company, you're buying it from your neighbor, and you're buying it from an institution. So you're really not doing anything for the company except for making its stock go up potentially. Um, but you're not truly investing in that company anymore. You're just investing in the price movement in the market. Okay. So to be too loyal to a company because you say, oh, this is a great company because of what's the term? Uh, oh, this is a three-letter ESG. If you're doing it because it's a environmentally responsible company, or it does this or doesn't do this or whatever it is, you're really not doing anything with the company. You're doing something with the person that might have bought and sold it with you. Bonds key to long-term growth. That's just out there. That's You always got to buy bonds. That's everyone in the financial world is always saying that. You got to have some percentage of your bonds as a portfolio. I can I can assure you that's not necessarily the case. Um, we talked about gold. Earnings drive price. Um, as you get more involved in the stock, if you go back and you look at earnings and what the expectations were and all that, you'll notice that things that drive price of a company stock oftentimes have nothing to do with the company even. So you'll see many times that earnings will come and it'll just be a bad day in the stock market, and that stock will tank, or earnings will come, you know, kind of poor or not so or mixed, and the stock will go up. So there's other influences in the stock price besides earnings that have to be contended with within trading. And at the Pinnacle methods, we identify those all the time. We use many different aspects of ETFs and sector funds to really identify, what is a good buy, what's a good sell for a company, regardless of its earnings. And we know that Wall Street isn't necessarily smarter than the average investor. And I would like to put the independent investor in there, because we have uh, many opportunities to not think as much as they do, and do a better job at being effective on actually making and protecting our money. Options are too hard and too risky. We talked about that. Market timing never works. And That's or they say that's only for experts. Um, Very much not true. That's what we do, and we do it consistently and I would say successfully. So watch for that. Market timing is only for experts, as I just said, and it turns out they're not very good at it either. Because again, going back to the individual, if you're unique, you can potentially get out of something much quicker than an institution can. You don't have a $10 billion account, I'm assuming, and they can't necessarily sell everything all at once because it'll tank the market. They have to manage things a little differently. But an individual, you can time in and out very effectively and save or make money much quicker than they can relative to your full account size because of the nimbleness that you might have. So market timing is the way an individual can do very well in the stock market. Stocks are very risky to invest in. That's just something that people think. And at the Pinnacle Methods, we'll show you that they're not as risky as the buy and hold strategy of the industry or the conventional wisdom is. So groupthink, as I said, um, it's making decisions as a group in a way that discourages creativity. So all of those things we just talked about, that's a lot of those misnomers are as the result of groupthink or not challenging the status quo or challenging ideas, but very stale environments when it comes to creativity and thinking. It also um, discourages creativity, like I mentioned, and individual responsibility and potentially productivity. If the group isn't doing things new or looking at things a little differently or just trying to tune what they're doing, they're not getting better. And the state of the human existence is you have to get a little better all the time or you're going to rot on the vine, right? Green and growing, rot on the vine. And that is what groupthink does to an organization. Also, it can just send you off in a path that's totally wrong. Again, we saw a lot of that in the last 3 years, where you're going on a path and bringing all these people with you, and everybody's going nowhere with it, right? Um, and again, in the last 3 years or 5 years, 10 years, whatever, challenging the status quo, whether it be financial institutions challenging each other, financial, wizards of smart going against each other, they can get shunned if they go against it. For instance, when I talk about I'm not a proponent of diversification, that's just not acceptable in the financial managers world. You can't say things like that. So they just don't. They don't ever challenge it and they're stuck with it. So it took them so long to realize that bonds were not the thing to be in during down moves in the market because bonds were going down right with the stock market and up with the stock market. So those things they didn't see, but we could see them a little earlier and accept them because facts are facts. And most importantly about that group think and the financial world is what they do is their intent is to keep you from doing something else. They want you to play in their world. Keep playing in my world and don't do something else because if you play in my world, it's good for us. So very, very logical. Um, and in many cases, again, it's not innocently applied. They do it on purpose. They want you to be captive to what they do and by their services and all that kind of stuff. Okay, so we're going to wrap this up in about 5 to 10 minutes. And very quickly, it's just a little summary of what we do at the Pinnacle Methods and Pinnacle Institute. Um, Based on this slide is from one of our classes, and it's a culmination of many things as we walk through things. And you'll see in our classes that we do a lot of logical movements through, the people aspect and the trading aspect, and kind of merge them together as we go. And I personally really have a passion for uh, putting a connection between the person and what's the right thing for them to be doing at that time. So, why do investors historically exceed their goals? In summary, they manage their risk. And risk is how much you're willing to lose on a particular position, whether it be a trade or an investment. They manage their risk. They get out when it's going against them. That's managing your risk. Stopping out is also something I haven't mentioned that financial advisors and everybody they don't do, right? They write it down. But when you're managing supply and demand, you know when that trade or that investment is going bad, and there's a way to get out of that. You take advantage of that, so you're managing your risk by stopping out. We also manage our risk by getting out when the profit is acceptable to us. So it goes both ways. You can get out of a position because it's going against you, and you can get out of your position because it's going great for you, and you're seeing an area where it may have some difficulty continuing, on the direction that you wanted it to. They don't waste time. um, I mentioned that we're at the when it comes to options. There's ways to make money just based with time in options that a lot of people don't know. But being in cash oftentimes is just a waste of your assets. It's not putting your money to work. And there are ways and options with doing that very cheaply, and with very low risk, or very high probability relative to other things. So the important thing is if you got money on the sidelines, they don't waste time. They don't just wait for perfect. They're always looking for opportunities to take advantage of the financial price movement in the markets that is always there. And they act when opportunity knocks. So investors and traders, they exceed their goals when they act when the opportunity knocks without forcing it, without getting too enthusiastic. They wait for the opportunity, the price to come to where it's on sale as declared by their analysis, and also the targeting opportunity when it's exceeded or reached the goal that they're looking for. They accept it without forcing it, without jumping in when the price moves. When a news event like we had one earlier today, jumping in when the news event hits and thinking it's going to go this way or that way. That's not how people are going to exceed their goals. They have to stay within a plan. They have to stay within a consistent process that follows all three: manages a risk, doesn't waste time, and they act when that opportunity knocks, or they wait for that price to come to where they're willing to purchase or sell that security. It's really simple. It's not as easy to execute, but it's very simple in its simplicity. The idea that you need to have your goals be very, very complex in trading is not important if you can bring it down to some guiding principles that allow you to kind of balance what you're doing against them. So when it comes to, again, the Pinnacle methods, how am I best determine when to get in and out of a position? Well, the Pinnacle method provides the confidence and skill to trade and invest in any market. So what we do doesn't have to do with bond markets, gold markets, stock markets, futures markets, forex markets, Bitcoin. Doesn't matter. The techniques that we employ can be used in all of those markets. For many people that are really stuck in the details of need to know all about a company or all about a commodity, or what OPEC is doing, or what's going on in the silver industry, or the mining of platinum and all of those kinds of things. um, if you feel like you don't need to know all that stuff, you can actually branch out and go to the markets that have the best opportunities at that time without batting an eye. Okay, you can trade, the S&P 500 today, and you can trade gold tomorrow, just based on where they're set up within their price movements. Okay, and it's very, very valuable. It allows you to do things consistently, without, again, forcing those trades on something that you're kind of married to. If you're really into a certain company or whatever, by learning the Pinnacle message, you realize, oh, it's very simple. I can just go do this today. I don't need to focus on what Apple is doing, because this other thing's coming into my zone as well. So we hope to provide the ability to make decisions on any security with that same methodology. All right, very, very powerful. It's really hard to understate that. It's extremely powerful. When I first started trading in um, oh, what was that one? The Australian dollar, for example. It's like, what am I doing trading the Australian dollar? But I was just doing it with the methodology. I didn't need to know, what was going on in Perth or what was going on in Sydney. I just was trading the Australian dollar based on the charts itself. So it was very, very freeing for me to do that. Um, it also gets you independent from news sources and other inconsistent decision drivers. You notice, you could see it earlier in the presentation. I was talking about the news and all that, and how it has to be taken into account, taken with a grain of salt, and shouldn't be. for a really good trader, it should not be the basis of making decisions for getting in, getting out, and all that kind of stuff, because there's an agenda that's being presented in front of you, and there is no agenda in the price movement. When it comes to the charts, when it comes to the price movement, there is no agenda there. It is what it is. Um, Included in those, as I mentioned, stocks, options, futures, cryptos, currencies, all of those have added an edge, if you will, using supply and demand methods, and enables a consistent process because all of those um, securities can use a consistent process. You can't be really good at trading one thing and really bad at trading another thing. You're just either a really good or really bad trader. No, I'm just kidding. But your process being the same for all of those gets tested whether you're trading oil or McDonald's or uh, the Aussie dollar pair. It's all, or Bitcoin. It's all the same process. You're just managing your risk, not wasting time, and getting in when the price comes to where you want to buy or sell it. That's the key thing. And that's a very hard thing for many people to understand. But once they see it a few times and experience it, they'll see that, hey, I don't need to be so anxious here. I'm just looking for the price that I see on the chart, and the rest of it just kind of take care of itself. Uh, in support of anyone that comes with the Pinnacle Institute, um, we sift through all what's gone on the previous night, and present it in a 45-minute session that shows markets and opportunities, gets the theme of the day, or the week, as it might be reviewed for the week. Early in the week, we review the previous week. End of the week, we review the previous week, and potentially um, a little bit of information on what might be coming in the upcoming week. We make sure that the important news is addressed and ready and prepared for that day. News does move price. We don't care about the news itself as much as that it moves price. Um, and again, long-term and short-term sentiments are always um, sprinkled in a recession. So in about 45 minutes, um, a lot of confidence and understanding that you didn't need to do all the research necessarily from the previous day to have a good leg up on the attitude and the opportunities that might be presenting themselves for that day. There's also odds enhancers that we talk about that I won't talk about here, but those odds enhancers are brought into play, um, as they need to be in each of the forum session. So it provides insight and opportunities, the market conditions, and such. Okay. Um, just to wrap it up, remember that every trade or investment that you make that is outside of an investment trading plan, which means if you don't have an investment trading plan, you shouldn't be investing in trading. Um, it is disrespectful to the time and effort that you put into it. So stay with your plan, adjust your plan as it needs to be adjusted, and you'll be much more successful, and most importantly, you're much more content and happy with what's going on, because staying with the plan can be, over the long period of time, very, very rewarding, hopefully financially, but also from a perspective of reducing that anxiety that many investors and traders get. So thank you for participating. Again, there's some sessions that are free, presented by that founder that I mentioned before, Sam Seiden, on August 27th and 31st, and on September 10th. So I hope you enjoyed the session. And hey, Mick, I will talk to you later, and I'll be back in a few weeks. For those that are going to end up becoming a member at the Pinnacle Institute, I welcome you. Have a good one.